welcome to the Week in Markets. I'm Faye Graham, an investment analyst on the True Potential portfolios, and I'm delighted to be joined today by Paul Durrans, one of our investment directors. So Paul, really busy week in markets this week. We've had interest rate decisions from three of the major central banks, Bank of Japan and the Fed on Wednesday, and then the Bank of England yesterday. Maybe if we start off with the Bank of England. They conducted their first interest rate cut this cycle, lowered rates from 5.25% to 5%. That follows on from the ECB and the Bank of Canada, who cut rates earlier on in the year. What were your key takeaways from the meeting?
Yeah, I suppose, well, it's good news that interest rates are coming down. So we think from a consumer perspective, mortgage rates should come down. The cost of credit cards, auto car loans. So that's encouraging, but there's a reason why they're cutting interest rates. And we've had inflation at 2% for 2 consecutive months. We think inflation, what the Bank of England's target is, well, it's 2%. So that's the reason why they're cutting interest rates. Now, I suppose when we think about the Bank of England committee that make the decision on interest rates, so there's 9 members, they're actually quite split. The vote was 5-4, so it wasn't unanimous, and it suggests that going forward that the Bank of England may be a bit more cautious, patient in lowering interest rates further, given there's disagreements at the committee. But I suppose good news that interest rates are coming down, and if we look at gilt markets or UK government bond markets, yields have fallen, so prices have risen. But why the Bank of England are being cautious? Well, inflation is expected to go from 2% to 2.7% by the end of the year, and we still get some stickiness or elevated services inflation. And also you're seeing quite strong wage growth still. It's still running somewhere between 5.5% and 6%, and that wage is particularly coming through the public sector. So this is why Bank of England cut interest rates, but being patient.
Yeah, so cooling inflation allowed Bank of England to cut interest rates from quite restrictive levels. If we contrast that to Japan, where interest rates are still fairly low and accommodative, we've actually seen the Bank of Japan hike interest rates this week.
Exactly. If you think about the Bank of Japan and Japan as an economy coming out of COVID, they were very much late to reopen, and they've just lagged the global economic cycle. Inflation has been above 4%, which is quite unusual for Japan. They've historically had extremely low, if any, inflation. So they are starting to raise interest rates. So this is the second time they've done so, gone from 0.1% to 0.25%. So still really small if you contrast that with the UK, with interest rates now at 5%. So this is for them to just bring down inflation. Inflation is trending somewhere between 2 and 3%, but they're wanting to get that much lower, somewhere probably around 1%. So seen some strength actually come through in the Japanese yen. The yen has been really weak for quite a long time. You've actually seen this week, yen appreciation.
Yeah, really interesting. And then last of all, we had the Fed, who actually held rates unchanged, but pretty much confirmed a September rate cuts on the card. I suppose the difference there is they have a dual mandate as well. Yeah. So they look at inflation, but also employment for their policy. So you've got inflation, which has been on a downward trajectory, and also you're seeing the labour market cooling, and that's been confirmed by some of the data we've seen today as well. So investors are kind of questioning, has the Fed been a bit too cautious perhaps in holding interest rates?
Yeah, I think it's, the Federal Reserve have acknowledged that you're getting a better balance of risks between inflation and employment. Encouragingly, over the last 2 or 3 months, inflation has been trending lower, but importantly becoming in below economists' expectations, and that's a real positive, and it's pleasing that the Federal Reserve acknowledged that. They also acknowledged that the labour market, which has been exceptionally strong, is normalising gradually, and they've actually taken everything into consideration, decided against cutting interest rates, which the market was expecting in balance. However, data today suggests that the labour market is weakening perhaps at a faster pace than they had appreciated. So if we look at the unemployment figures today, they've gone from 4.1% up to 4.3%. So that's quite a big change. And also if we look at the number of jobs added to the workforce, that came in at 114,000 in the month. That was quite a lot below what was expected. So suggests that we're getting quite a rapid cooling within the labour markets, and therefore the market's currently thinking, well, perhaps the Federal Reserve should have cut interest rates this week.
Yeah, so potential to perhaps see a surprise rate cut from the Fed. I suppose moving on to corporate earnings now, we're well into Q2 earnings season. One of the themes that we've been looking out for actually within earnings is any signs of the consumer starting to pull back on spending. So just as a bit of background, post-COVID there was a lot of pent-up demand. Investors were finally able to go out and spend their money. Now you're seeing those excess savings deplete, and then so sort of some of the reports from the consumer names that we've seen this week appear to suggest that maybe the consumer is sort of starting to pull back a bit. So I think we had McDonalds, they reported weaker sales. You're seeing the consumer push back against those price rises, starting to eat at home a bit more often, also a bit more deal seeking. Yeah. I think you had Visa as well earlier on in the week.
Exactly. I think there's several indications that the consumer's not necessarily under stress in terms of their finances, but they're pushing back against any further price increases. They've consumed a lot over the last couple of years, whether it's in goods or services. But if you think about McDonald's, they've increased prices by 27% since 2019. And, the lower income cohort of the US workers are just feeling the squeeze a bit, and so are actually pushing back and being a bit more frugal in their spending, looking for deals where they can find them.
Yeah, exactly. And then I think we had some of the tech names report as well. Microsoft, anything you'd want to highlight there?
Yeah, I suppose it's been quite a choppy week within US technology stocks. You've seen large daily swings on the upside and on the downside. I suppose we heard from Microsoft. Now they actually beat on their earnings and sales, but in terms of their cloud services, the growth that they have delivered actually was slightly weaker than what the market expected. Interestingly, that they are actually spending a huge amount of capital on AI. So the amount of capex that they're spending is up 80% over the year. Now there's questions with, whilst they're spending a lot on AI technology and infrastructure, can they really monetize that, and how much can they monetize it? So they're thinking about the costs versus the returns. And so it's been a bit more challenging for Microsoft, certainly challenging for someone like Intel, who missed on their earnings. They've actually had to suspend their dividends, but that's more idiosyncratic given that they're losing market share within the tech space. But there are some beneficiaries, someone like Meta, who have gained a lot from the AI investments, starting to monetize it. So it is, it's becoming, seen a bit more dispersion within the tech sector. And so, an interesting observation.
Yeah, exactly. So I think we'll leave it there. So we've seen central banks starting to commence their cutting cycles. You've got the US labour market cooling as well, and also just some signs of down trading within some consumer cohorts. So thanks very much, Paul, and thanks everyone for tuning in, and we'll see you next week.